Joining me now, Phil Blancato, Chief Market Strategist at Osaic. Phil, thanks so much for being here.
Thank you for having me.
So, Phil, I want to kick things off with a disclaimer. We are filming this on Wednesday ahead of tech earnings and the Fed decision. So by the time our viewers are watching this, we'll have a lot more information. So regardless of those headlines, though, what's the investment story that's likely to matter long after the week is over?
I think it's a period of volatility that you have this situation, regardless of what the Fed does or does not do, and even tech earnings. We've seen company after company report exceptional earnings. Look at Micron Technologies, a really impressive earnings beat. The stock's down quite a bit from its high. So you have this period of time right now. It's not unusual, the July, August, September period, to have waves of volatility. And there's reasons for it this time, but there's always reasons. So I would expect investors to say, this is your opportunity to fill both fists with cash, go into the market and say, where is the stock that I've been wanting to buy today? Is it something that's finally on sale? Regardless of the Fed, the price of oil, or even earnings, what are the quality names that you want to own? I think is becoming, not quite yet, but becoming the opportunity to do just that.
Okay, so two-part question here. Where do you get those fistfuls of cash? Do you have to sell some of your winners to get it? And then when do you know if a stock is on sale enough if we're going to continue to see volatility?
That's two very good questions. I think you take the cash from where you have one, and I'm sure most of your viewers have won a ton in Nvidia or Palantir, which is off a bit, but it's not a terrible idea to rotate from the names that got us here to rotate to the names that I think are the next wave of leadership. So think about the software that got us here. Think about the chips that got us here. But now I think it's much more about the ancillary impact of AI, whether it's the cabling, the data centers, the power for it, or other parts that would not only diversify your portfolio, which is always a good thing, it also means you can go into a sector where I think we're going to get great growth. So that's where the cash should come from. And then the other part of your question, when I think about where we are from an impact standpoint to the next wave of this market and where what the volatility is going to look like and how I would manage my portfolio here. I think sometimes we've forgotten that in every sell-off there's opportunity. So looking for something that's been really punished for no good reason is a good place to start. And I'll make it simple on you. Look for a name that's off 15 to 20%. You're going to find them. Look at Micron, down almost 20% from its all-time high. And I'm not recommending it just yet. I think it's an excellent company. I have some other names I'll talk to you about today. But I think you want to draw the line at 10% down and then say, if there's something greater than that, why? And if you find, in most cases, with these double-digit, sometimes triple-digit earnings growth, that's where you make your bet.
But here's the issue. If we're seeing this rotation into other areas of the market, some of the hardest hit stocks are in tech. So does that mean that tech exposure overall should be less, or we should just be, adding exposure to other tech stocks?
I think you add exposure to other tech and tech-related areas. So I don't want you to add a tech, but think about what's coming, whether it's obviously the SpaceX is for this incredible jump to start, and now it's been a bit of a disappointment. I think it just takes time. With Anthropic and OpenAI behind it, those are names that are going to be very interesting to be a part of. But that aside, leave those crazy things aside that there's these mega IPOs. It's switching from, say, the Metas of the world, which is still a good company, but obviously struggled, to Google, which put up an incredible number, but yet still struggling, to other areas that say, today I want to talk to you about an energy company. And the reason why is it's AI related. You can almost argue everything is AI related right now. We think about a Western Digital, another company I really like right now. Companies that are putting up high double-digit earnings growth, if not triple-digit. And those are names that I think are still to benefit. So it's not that you're out of tech, but be tech and tech related. Why? Because as we move up the stream from AI to creation to implementation, you want to win on implementation and less on creation right now.
Okay, so Western Digital does fit the bill. It's down more than 25% this month, although still up over 150% year to date. What's the other AI company that you said you like?
It's an energy company. Now you got to think I'm crazy for calling it an AI company. It's called Mastec, but the company's going to post 170% earnings growth. It's got $20 billion backlog. Why? Data centers. So that's why it's AI related. They are a multifaceted energy company That's interesting in of itself, using different types of energy to meet this demand we have for power. But primarily, they're going to be a source of power for data centers. And why is it relevant? Because we need a lot more power. So I want to see your portfolio be paired. I want, on one hand, a Western Digital, on the other hand, an energy company. While they're both going to be impacted by the growth of AI, they both are necessary components in the food chain, the supply chain of AI. Without them, you don't have a successful implementation of AI. That's my argument. I want to see you do really well with companies that have incredible earnings growth, but are necessary for the future growth of AI. That, to me, is the difference.
Time for a quick break. Thanks to GoDaddy for sponsoring today's video. I spend a lot of time talking to people building businesses, so I wanted to see how easy it actually is to go from an idea to a working website using AI. So I decided to put GoDaddy Aero AI Builder to the test. Instead of writing code or starting with a template, you just describe what you want in plain English. I asked it to build a website for a financial newsletter with a place to publish market insights, feature video interviews, and grow an email list. It asked me a few questions about what exactly I wanted to build. Then, within minutes, it turned that prompt into a working website. Then I refined it through conversation. I asked it to change the colors, rewrite the copy, reorganize the homepage, update the header, and even redesign the logo. And it updated everything from those prompts. When you're ready to publish, hosting, security, and a subdomain are included. Every site is also optimized for search engines like Google and AI answer engines from the start. If you're wondering, no, I'm not actually launching a newsletter, but maybe I should. Stay tuned. Anyway, if you've had an idea sitting in your Notes app because building a website sounded way too complicated, this makes it feel surprisingly approachable. Click the link in my description box or scan the QR code to start using GoDaddy Aero AI Builder with 50 free credits. Thanks again to GoDaddy for sponsoring today's video. So AI is still very much the theme as you look ahead, but we have seen this pretty sharp sell-off in tech. Do you look at that at all as a sign that the AI trade is starting to crack, or is it really just a reset before the next leg higher?
I think it's a reset before the next leg higher. There's been some profit taking. That's normal. Look, I'm a big fan of small cap stocks. I think international offers a defensive play in your portfolio. But there's no denying when we have a $700 to $1 trillion spend this year on AI, that to some degree is inflationary, but on a bigger picture is an impact with all the companies that feed off that trough. So sure, we had a little bit of sell-off here, but you've had these incredible years of explosive growth. Eventually, there's some profit taking, especially at a time when the narrative is, did they spend too much? Is my favorite phrase is the juice worth the squeeze. In other words, is all this spending going to really equate to something more powerful? And when you look at today's data, of the 22,000 companies that are effectively using AI every day in an intense manner, they're adding people to the workforce, not detracting. Their productivity is up anywhere from 5 to 8%. The future of American productivity is in AI. So I think it's just an opportunity to pivot and be prepared for a multi-year period of growth in this sector. Not this explosive growth, not these ridiculous 20, 30, 40% returns. I think that's silly. But I do think a steady growth in your portfolio, not this is the only portion of it. You want to be not just in AI, but have it as a core component of your portfolio.
We'll talk about the other portions of the portfolio in just a second, but just bringing it back to the Mag 7, obviously we'll know a bit more when the big tech names report, four of them today and tomorrow. But have they peaked, do you think? Or do you think that they will be part of the next leg higher once we see this reset and profit taking play out?
I was never a fan of painting them all in one broad brush because they are really different companies. But for example, if you're a $3 trillion Apple Apple company, Apple's a $3 trillion company, almost $4 trillion today. If you think about that, to make it an $8 trillion firm is really hard. That's a lot of sales globally and domestically. So there's so many things that impact a company that's that size to make it bigger. There is a headwind, there's a ceiling on all these names, whether it's Nvidia, Meta, or Google, and so on. Look at the antitrust suits that Google's fighting in Europe. So I don't think these names should be painted in one fell swoop. I think Google's probably the leader of them all right now. Nvidia's stocks has been really difficult to push higher, especially at a time when China's trying desperately to take them out of their supply chain. So I would say I'd rather see you have less Mag 7 and much more of the other stocks. But if you had to ask me which of the Mag 7 I like the best, I'll give you a Mag 8. I'd say SpaceX over all of them. I think the long-term opportunity in SpaceX is quite fascinating. But I'd go differently and say if you had to force me to pick one, I put Google first and Apple second, and the rest are going to take some time to capitulate. Microsoft's an outlier, and that is something we use every single day. But again, a massive company that's going to make it very hard to grow from here. Not at a prolific growth rate above the market.
Okay, well, SpaceX fits the bill as well, down more than 30% in July,
Yeah.
trading around 112 right now. I heard you mention small caps. I heard you mention international. Talk to me about the other portions of the portfolio. What areas outside of tech look most attractive to you right now?
So to be provocative, I don't think the Fed hikes rates. I may be wrong about this, but let's assume as we go forward in the next few months here, we don't get a Fed rate hike. I mean, the only way that happens is a really a significant increase in the conflict between Iran and Israel, the United States, and so on, where we see oil up somewhere around 120 to $140 a barrel for an extended period of time. Much of what I'm telling you today will change. And for that reason, you want some defense in your portfolio. Not that international or small caps will represent defense. We could talk defense in a second. But if assuming that doesn't that happen, that's not my base case. Oil goes back to 70, $75 a barrel. But once once there's a resolution in play for Iran. But the reason why I like small caps is I think we're in a deflationary world, not inflationary. I think the K-shaped economy, as well as technology, specifically AI, is deflationary long term, not inflationary. And why that's relevant, I think we do get back to a 2.5% inflation rate. But when you couple the productivity that AI does for small caps, plus the lower borrowing rate somewhere over the next 12 to 18 months, I think it's a great opportunity when you see earnings growth in the small cap space between 30 to 50%. So that's why I really like it. I don't think the U.S. consumer is stressed. The low-end consumer is a bit who spends in these places, but nothing of significance yet. Our labor force is quite strong. Again, big win for small caps. And when I think about that area, I just think it's a great way to diversify your portfolio. Look at the returns this year, more than double the S&P. And international's going to have no choice but to rebuild their defense with $2 trillion over the next 5 years. So I think it acts for a dividend play and a relatively solid growth play, especially when international stocks still traded about a 30% discount to U.S. stocks.
As you're thinking about adding small caps and international exposure to your portfolio, do you get that through having to stock pick, or do you get that through index funds then that are a bit broader?
It's a really good question. I know many of your listeners, I don't want to make this alphabet soup. I absolutely prefer an index fund for those areas. Why? Because it's much harder to pick the winner and loser in small cap and international, especially small cap. Small cap is inefficient. What's that mean? More bankruptcies happen in small cap than people realize, more lack of success stories. And there are some big winners that push the indexes higher. And what happens is when a small cap stock gets big enough, it gets pushed up to another index. So by being in an index-based, actively managed ETF, I think it's a very smart way to win there. You don't have to try and decipher small cap earnings. It's much harder than large cap. And international, the problem with international, why I would use an actively managed ETF there as well, is because we know international has been a boring place to be for the better part of the last 10 years. Leaving last year aside, international has not been a win. Even this year, it's just tied with the S&P. So we're doing this based on a spending story, and why I'd rather see you buy an ETF rather than a stock, because the spending story hasn't developed yet. We don't know where the money is going to be spent exactly. Will some of it be spent in the United States, some of it overseas? What happens with Ukraine-U.S. partnerships in defense? Where does that become an area where Europe will spend? So there's still some unknowns. So the reality of the money being spent is why I like it. The not clear picture of how it's going to be spent is why you buy an ETF rather than individual companies.
Okay, bringing it back to the broader market, you kicked things off by saying you expect a volatile period. So how should investors know if that volatility is normal and just kind of part of the process? We know the market can't go up forever. And when should they start to worry?
Well, look, we're still up about 8% on the year, so it's not like it's a bad year. It's still a pretty phenomenal year for the S&P 500. Anytime you see a correction of 5%, I want you to take a pause. And the reason why, there's 5% corrections in every single year. There's usually one of 10% just about every year. So in that sense, the only time you have to really worry about a market washout is there's something unusual happen that's changing the market's momentum. And granted, right now with oil pushing up higher because of the latest conflict, with the Fed sort of being a bit of a unusual place in that the Fed chair saying one thing and there's some dissenting by the Fed members. So that could create it. In a scenario where we had the Fed raise rates and oil over $100 a barrel, that's going to cause a 10% correction instantly. That would be a really tough day. But remember, seasonality matters. Traditionally, August is a pretty tough month. We're not quite there yet. And September is even harder. So you got one seasonality. This time of year is always very volatile as we take a hard look at the fourth quarter and what's going to be the best winners in the fourth quarter. And then beyond that, I just think you have this problem right now where we've had great markets for many, many years. We still have strong earnings. Look, you have over 20% earnings growth for the S&P 500. This is incredible. Margin growth on the S&P 500. How much companies make? If you run a company and you make 10 cents on the dollar, that's a really good year. Well, guess what? We're talking 15 cents on the dollar. So you're looking at incredible earnings growth for the average company out there. Incredible just profit growth for companies out there. So in that kind of time period, you rarely get corrections of 10, 15%. So a 5% correction is a chance for you to reevaluate, look where we are, look for those names like you've mentioned already, great names that are down a lot. I don't think you worry so much about the broad market. I think you worry about what's that name you always wanted to buy. Is it finally cheaper like we opened with? And that's where you focus your attention.
Okay. And over the next 6 to 12 months, volatility aside, do you think this is a market that will be higher than where we are now?
And that's an excellent question. So I don't know if you're going to like my answer. The return back to normal is something that I think folks have to be prepared for. You see, folks, we've been living in a bit of an abnormal world for the past 10 years with returns on the S&P between 13 and 14% on average. I don't think that continues. And the reason why I don't think that continues is government spending is being culled in domestically, internationally. We're not spending prolifically the way we did post-pandemic. Earnings growth, while quite strong, has to help prices equal the amount companies earn. If you look at the P divided by the E, price to earnings ratio, we're starting to get back to somewhat normal earnings momentum. And that means probably something like 16 to 18 times earnings on the S&P, not 22. So what does that mean? Probably average S&P 500 growth of 6 to 8% over the next 12 months, not 30. And I think that's where some folks get caught up on. Give me one caveat, one little caveat, that the third year of the election cycle is usually the best year of the S&P 500 of the 4-year presidential cycle. And at a time when more than likely the House and Senate will flip one, two, maybe both, it means not a lot of things are going to change in the years after the midterm. The market likes that. So in a scenario where there's not a lot of change and we continue to get solid earnings growth, you could do a bit better, 12 to 14% on the S&P next year. But I want you to have the expectations of more of around 8.
All right, so it might be a roller coaster and we might get right back to where we are right now. I think this is a great place to pivot to our rapid fire game of this or that. The quick questions, quick answers, no hedging. Okay. I know this is your first time playing with this, Phil. Are you ready?
I can't wait. I'm excited.
All right, here we go. Stocks by year end, higher, lower, or flat?
Flat.
Second half, optimistic or cautious?
Cautious.
Stay invested or raise cash?
Stay invested.
Pullbacks, buy them or fear them?
Buy them with both hands full of cash.
Add risk or play defense?
For now, defense.
Market leadership, broadening or tech comeback?
Broadening.
Tech sell-off, opportunity or warning sign?
Opportunity.
Semiconductors or software?
Ooh, semiconductor.
Software name you would buy here?
Salesforce.
AI builders or beneficiaries?
Builders.
A builder that's a must own?
Mastec.
A beneficiary that's a must own?
Western Digital.
Small caps or large caps?
Both. That's a terrible answer. Small cap.
Western Digital or Nvidia?
Western Digital.
One sector you'd avoid in the second half of the year?
Staples.
One sector you'd buy?
Discretionary.
One stock everyone will wish they bought by year end?
Encino. NCNO.
Finish this sentence. I would turn bearish on the market if...
oil goes above $120 a barrel.
All right, we'll leave it there. Phil, really appreciate you joining us. Thanks so much.
It's a lot of fun. A lot of fun. Thank you so much for having me. I really appreciate it.
That's Phil Blancato of Osaic. If you enjoyed this Street Talk, check out our full interview with Liz Thomas. She says the S&P 500 has not peaked yet and shares the sectors to buy now.